Silver crossed $94 per ounce yesterday. Within 6 hours of that crossing, 3 separate institutional responses occurred that reveal far more about systemic pressure than any price movement could indicate. The Federal Reserve issued an internal memo regarding precious metals market stability monitoring, the first such directive since 2011. The Bank for International Settlements published updated guidance on commercial bank precious metals exposure limits. The London Bullion Market Association quietly increased delivery settlement times from T+2 to T+3 for all silver transactions. These responses were not triggered by a price movement from $93 to $94. They were triggered by proximity to $100, a number that represents far more than market value. Throughout monetary history, certain price levels function as psychological system thresholds rather than simple market metrics. When silver approaches $100 per ounce, it crosses from commodity pricing into monetary recognition territory. This crossing threatens the foundational assumption of fiat currency systems, that paper money retains psychological dominance over hard assets. The institutional response to silver's approach toward $100 reveals recognition that this threshold represents a confidence boundary rather than a trading level. This is not about whether silver reaches $100. This is about what happens to system stability when a precious metal approaches psychological parity with century denomination currency units. When an ounce of silver costs the same as a $100 bill, the relationship between paper and tangible value becomes uncomfortably obvious. The current system operates on the assumption that most citizens never mentally calculate the relative purchasing power of currency units versus hard assets. A silver dollar worth 100 paper dollars creates cognitive dissonance that historical precedent suggests leads to system stress. Financial media will analyze this movement in terms of supply, demand, and trading opportunities. They will discuss technical resistance levels, institutional positioning, and market sentiment. This analysis misses the fundamental reality entirely. Silver approaching $100 is not a market event. It is a confidence event. The price level itself becomes a statement about the relative credibility of paper currency systems versus tangible alternatives. The real question is not whether silver breaks through $100 resistance. The real question is why certain price levels create institutional panic responses that reveal the psychological infrastructure supporting fiat money systems. Throughout recorded history, specific price relationships between precious metals and currency units have consistently triggered system-level responses from monetary authorities. These responses occur not because the metals themselves threaten economic stability, but because their pricing threatens psychological acceptance of paper money systems. Rome experienced this pattern when silver denarii began trading at premiums to their official weight ratios. Citizens started calculating the actual silver content versus the stated currency value. When those calculations revealed systematic debasement, confidence in the currency system collapsed faster than the physical debasement rate itself. Archaeological evidence from the reign of Emperor Gallienus shows that silver began trading independently of official currency designation when the gap between metal content and stated value became psychologically obvious. Citizens could mentally calculate that official coins contained progressively less actual silver while maintaining identical currency denominations. The crisis accelerated when silver reached price levels that made the debasement calculation simple. A denarius officially worth 1 unit contained silver worth 3 units at market rates. The mathematical relationship became too obvious to ignore, triggering widespread rejection of official currency in favor of weighted silver transactions. The system breakdown occurred not when debasement began, but when debasement became psychologically apparent through easy price comparisons. Weimar Germany followed an identical pattern during the final phase of hyperinflation. The psychological breaking point occurred when gold reached price levels that made the calculation of currency debasement simple for ordinary citizens. During 1923, Germans began measuring prices in gold grams rather than marks because the relationship had become mathematically obvious. A loaf of bread cost the same weight in gold throughout the crisis, but required exponentially increasing quantities of marks. When gold reached price levels that made this calculation immediate and obvious, currency rejection accelerated beyond policy control. The Weimar government's final attempt to restore currency credibility focused not on controlling the money supply, but on controlling gold pricing. Officials understood that visible gold prices provided citizens with a measuring stick for currency debasement. Emergency regulations attempted to fix gold prices below market levels to preserve the psychological viability of paper money. These regulations failed because the underlying mathematics remained unchanged. Citizens simply shifted transactions to international markets where gold maintained market pricing. The psychological threshold had been crossed, making currency restoration impossible through price manipulation. Britain faced identical dynamics when sterling approached specific psychological relationships with gold during the 1930s. the crisis intensified when gold reached price levels that made currency devaluation calculations simple for international holders of sterling bonds, when gold rose to levels that made the calculation obvious that British currency was losing value at specific, measurable rates compared to tangible assets. International confidence collapsed. Foreign governments began demanding gold delivery rather than accepting sterling promises, accelerating the reserves crisis that forced abandonment of the gold standard. All three examples demonstrate that system stress intensifies when precious metals reach price levels that make currency debasement calculations psychologically immediate and mathematically obvious. Current monetary systems face identical psychological dynamics, but with global synchronization that prevents the geographic arbitrage available during previous crises. When silver approaches $100, it provides citizens with an immediate psychological comparison point for evaluating paper money credibility. A $100 bill represents the largest commonly circulated currency denomination in the United States. When silver reaches price parity with this denomination, the psychological comparison becomes immediate. Tangible metal versus printed paper, each worth identical amounts. This comparison forces the question that fiat money systems depend on citizens never asking. Why does printed paper maintain equal value to refined metal that required mining, refining, and transportation to produce? Central bank responses to silver's approach toward $100 indicate institutional understanding that this price level creates psychological pressure on currency credibility rather than simple market dynamics. The Federal Reserve's Precious Metals Stability Monitoring Directive represents preparation for potential currency confidence effects rather than commodity market oversight. The BIS guidance on bank precious metals exposure limits addresses systemic risk from psychological preference shifts rather than trading losses. The LBMA delivery timeline extension indicates preparation for increased physical demand driven by psychological preference changes rather than industrial requirements. These institutional responses reveal recognition that $100 silver represents a confidence threshold where citizens begin questioning the relative value proposition between tangible assets and currency promises. The current global monetary system operates within structural constraints that make this psychological threshold particularly dangerous for system stability. Government debt to GDP ratios average 107% across developed economies. Central bank balance sheets have expanded by $15 trillion since 2008. Currency creation has accelerated to levels that would have been considered impossible during previous eras. These conditions create vulnerability to psychological confidence shifts that previous systems could absorb through geographic arbitrage or international diversification. When all major currencies are simultaneously debt-based and simultaneously expanding their monetary base, citizens cannot escape to alternative currencies during confidence crises. This creates unprecedented vulnerability to psychological threshold effects. When silver reaches $100, citizens cannot switch to other currencies offering superior credibility. They must choose between remaining within the global fiat system or exiting to tangible alternatives entirely. The institutional preparation visible in recent policy changes indicates recognition that $100 silver could trigger preference shifts that current monetary infrastructure cannot accommodate without systemic stress. Central banks cannot print additional silver to meet increased demand. They cannot manipulate silver supply through policy decisions. They cannot create psychological acceptance through monetary expansion that historically worked to restore confidence in paper systems. This creates the impossible policy position that defines system threshold events. Increasing currency creation to address confidence problems actually accelerates the confidence problems by making currency debasement more obvious. 3 persistent misconceptions prevent clear analysis of psychological price threshold effects in monetary systems. First, price levels are arbitrary and have no inherent significance beyond market sentiment. This assumption ignores the historical evidence that specific price relationships consistently trigger systematic confidence shifts across different cultures and time periods. The psychological impact of simple mathematical comparisons between tangible and intangible value appears to be a consistent feature of human monetary behavior rather than arbitrary market sentiment. Second, modern financial systems can manage psychological preference shifts through policy intervention. This assumes that psychological responses to obvious mathematical relationships can be controlled through official statements or regulatory changes. Historical precedent suggests that once threshold calculations become psychologically obvious, institutional credibility decreases rather than increases through intervention attempts. Third, citizens will maintain preference for currency systems regardless of precious metals pricing. This assumption ignores the demonstrated pattern where psychological threshold crossings lead to preference shifts that accelerate beyond institutional control capabilities. The London gold pool experience demonstrates these limitations clearly. Despite coordinated intervention by 8 central banks between 1961 and 1968, gold continued toward price levels that made currency debasement calculations psychologically obvious. When those price levels were reached, intervention attempts actually accelerated confidence loss by confirming that authorities feared the psychological implications of transparent pricing. Modern central banks face identical constraints with more limited policy options. Gold pool participants could ultimately abandon intervention and allow price discovery. Current central banks cannot abandon currency systems without triggering complete economic reorganization. This creates systematic vulnerability to psychological threshold effects that previous monetary arrangements could resolve through system transitions. Current arrangements have no obvious transition mechanisms, making threshold crossings potentially more disruptive than historical precedents. Understanding silver's approach to $100 as a psychological system threshold rather than a market resistance level reveals why institutional responses focus on confidence management rather than price control. Silver approaching $100 per ounce does not represent a commodity market event that can be managed through supply and demand intervention. It represents a confidence event that challenges the psychological infrastructure supporting global monetary systems. When Roman citizens began calculating silver content versus currency denominations, the crisis accelerated beyond administrative control because the psychological foundation of currency acceptance had been damaged. When Weimar Germans began measuring prices in gold rather than marks, currency restoration became impossible because citizens had mentally shifted to alternative value measurement systems. Current institutional preparation for silver approaching $100 follows identical logic. Policymakers understand that certain price relationships create psychological preference shifts that cannot be reversed through monetary policy once they become mathematically obvious to general populations. The Federal Reserve, Bank for International Settlements, and London Bullion Market Association responses indicate recognition that $100 silver represents a potential confidence boundary where citizens begin questioning fundamental assumptions about relative value between paper promises and tangible assets. This analysis leads to an unavoidable conclusion. Silver's approach to $100 reveals more about monetary system vulnerability than about precious metals market dynamics. The institutional responses demonstrate that certain price levels function as system stress indicators rather than trading opportunities. System signals indicate that psychological price thresholds retain their historical significance in modern monetary arrangements. The mathematics of currency debasement becomes psychologically obvious at predictable price relationships, regardless of technological advancement or institutional sophistication. Central bank precious metals monitoring represents preparation for confidence effects rather than market management. The guardians of fiat currency systems understand that their credibility depends on citizens never making obvious psychological comparisons between paper and tangible value. Silver is not approaching $100 because of market dynamics. Currency systems are approaching a psychological credibility threshold that precious metals pricing makes mathematically transparent. The system has reached a boundary. The threshold approaches. The psychology remains constant across centuries.